Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into Cognyte's second quarter results and a pretty baffling reaction from the market. All right, let's get right into this paradox. On one hand, you have Cognyte putting up what looks like a really strong quarter. They beat revenue estimates, and they even raised their guidance for the rest of the year. But on the other hand, the stock just tanked. So what's really going on here? What did Wall Street see that the big headlines completely missed? That's the key question we're going to unpack. We need to dig past the official press release and figure out why the company's story and the market's verdict were two totally different things. Okay, so first up, let's look at the bull case. I mean, the numbers do look good on paper. Let's walk through what management was so excited about on their call from September 9th. And the bull case kicks off with that top-line growth. Revenue came in at $97.5 million, a solid 15.5% increase from this time last year. A nice beat. But here's where the story gets even better for the bulls: profitability. Their adjusted EBITDA grew a whopping 33%. That's more than double the rate of revenue growth, which is exactly the kind of operating leverage investors love to see. And if you want to know how they're doing that, look no further than the software revenue line. It shot up nearly 36%. That right there is the real engine behind their expanding profit margins, and it shows their big strategic shift is really starting to pay off. And this wasn't just about one good quarter. Management came out signaling a ton of confidence for the future. They raised their forecast for the entire year, and they doubled down on their big long-term goal, hitting $500 million in revenue by fiscal 28. That's a bold target. So you add it all up: a beat on earnings, a raise in guidance. That's the classic recipe for a stock to go up. So why on earth did this one get hammered? Let's flip the coin now and dig into the bear case. And the reaction wasn't just a little dip. It was fast, and it was pretty brutal. Cognyte shares plunged 12%. And look, this wasn't some bad day for the whole sector. The main cybersecurity ETF, Hack, was basically flat. No, this reaction was all about Cognyte. So here's what was really going on under the surface. It seems investors just looked right past the headlines and dug into the details. They saw that the official operating income number actually missed some of the higher whisper numbers that were going around. There were also whispers that the revenue beat just wasn't big enough to justify the stock's high valuation. And, to top it all off, management themselves mentioned some procurement delays in the super important U.S. federal market. But despite the stock getting crushed, management on the call really tried to steer the conversation back to the big picture: their long-term strategy, which is all about AI and expanding their market. The CEO's message was pretty clear. He was basically saying, hey, calm down, these US headwinds are just temporary. His point was that their core strategy is on track, and they're betting that the growing complexity of the world will just keep fueling demand for their products. They're playing the long game. And to back that up, they laid out this clear path to their $500 million target. Now, it's an ambitious plan. The roadmap implies they're going to need to keep up consistent double-digit growth for the next couple of fiscal years to hit that goal. All right, so we've heard the good and the bad, the bull case versus the bear case. So where do we go from here? What's our official call on Cognyte going forward? Here's how we see it playing out. We're going to break our forecast into 3 simple parts for you: what to expect next quarter, how we think the stock's going to trade, and of course, our final rating. So for Q3, we're anticipating some modest growth, pretty much in line with management's own guidance for revenue to be slightly higher. But the stock price itself, that's now a show-me story. It's probably going to be stuck trading in a range until the company can deliver a truly blowout quarter that proves it can get ahead of the market's really high expectations. Therefore, we're initiating our rating at market perform. Look, the company's fundamentals are solid, and the growth story is credible. But after this recent pullback, we think the stock's valuation is now pretty fair. The potential upside and the potential downside just feel very balanced from here. So the key takeaway here is pretty clear. The headline numbers on earnings day almost never tell you the whole story. As always, it is so crucial to do your own research. And please remember, this analysis is for informational purposes only. It is not financial advice.